Right. Okay, guys. Good evening and welcome back. Hope you guys can hear me properly, right? So let's start the class. We are discussing the introduction lesson. We finished last week about the stocks, right? Hope you can remember the double entries related to purchase stocks, sales stocks, return inwards, return outwards, so sales return, purchase return, likewise. Owner's goods drawings. We discuss everything, right? Okay, now today what I'm going to do, I'm going to continue. I think we start from here, right? So it's about expense on credit. Am I clear? Right? Okay. So the business purchase and goods on sales on goods. This may also incur business and services that are initially provided uh, them on credit. Business agreed to pay a later date. I think we done this, right? Okay. On 24th April 2017, a business asked Banco Garage to service the business van. The business later receive an invoice for the 260 for the payment within 10 days. The initial double entries are as follows. Debit, motor expense account, credit, Banco Garage account. We need to do this. You know, like the services are received by the business, the benefit goes in. Credit Banco Garage account. The business owns Banco Garage for the servicing of the van. You know, so a liability has been incurred, right? So the liability is always a credit in. Now, we are discussing here ledger accounting and double entry book. Ledger accounting and double entry bookkeeping, right? You can. So under that, now this is about expense on credit. I'll explain it. On 20th March 2000, the business sends a check 246 to Banco Garage in payments of the outstanding account. The double entry for the payment of the account is credit bank account, debit Bangkok's Garage account, right? Like this. Now we are discussing about expenses on credit, right? We are discussing about expenses on credit. Right, think this is the business, right? This is now we maintain accounts in one business perspective. We can't account maintain accounts in both business at once, because there is a subject matter. It's the subject matter thing. This business, this is ABC business, right? And this is another business. We are not concerning about their accounts. We are maintaining this business. I think this is uh, XYZ computer repair shop. Can you hear me? Send me a thumbs up. Hope it's clear to you, right? Are you okay up to here? Right? All good? Right. Now think this XYZ computer repair shop uh, repair. I'll take LKR. LKR rupees 500 worth of repair service on credit. Let's take the date today. Today is all about 17th July 2020. Then they send the invoice as well. After that, now the business is, now this is point number one, right? Number two, business now sending, paying via check, paying via a check, rupees LKR 500,000, right? So the date is, let's take 20th July 2020. When we take the accounts of this business, right? So the business repaired the, now repair is an expense to this business. Understand? This business obtained the repair service. So he opened an expense account called computer repair expense. Account, right? This is an expense categorized account. This is an expense account, right? Business computer repair expense increase because I told you every time expense increase most of the time, right? The date is 17th July 2025. Value is rupees LKR 500,000, and the business still haven't paid in this point. So the other business, XYZ business, need to identify as a liability. Why? Still not paid. So this is a liability. Liability, right? 17th July 2025. 500. Change the account names. Computer. When liability increase, credit decrease. Any asset increase, debit decrease. Okay. Computer repair YZ business. Now the business is paying via check on 19th or 20th of July. Business paying via check. So business bank asset decreases. So bank account credit. This is an asset account. Increase debit, decrease. 17 July 2025 to 19, paying on 19. When the business issue check, now think this business issuing the check. Just issuing check doesn't mean money is transferring, but at the point of the issue, now think this business issuing the check on 19th to this XYZ business. Think this business bank account is in BOC bank. When this business present that check to the bank, then that that bank will contact my bank, which means ABC business, and collect the funds from the my bank. It will take 4-5 days, but at the when the point of the issuing check, at the point of the issuing check, the business think we can't wait. We don't know when the bank account balance will decrease. But since we can't guarantee about the date, we don't know about, because Some, you know, the validity period of a checks. How long is the validity period of check? Can you tell me? How many days? Any idea? Can you hear me? Yes, right?
Sir.
You know how validity period of a check?
No, sir.
It's 6 months. How long? 6 months, right? From the day, the check date, right? Now, since we don't know when this person will present this to the bank, so because of that, at the point of the issuing check, at the point of the issuing check, we think in future the bank money will decrease. This person like will not keep the check for longer period of time because check is just a piece of paper. This person wants money. If this person wants to get the money, he need to deposit the check his bank, right? So we don't know when will happen, but when we are giving the when we are issuing the check, we think future the bank money will decrease, so we are crediting the bank account. The date is 20th June 2025. So when we give the check, our liability decrease. So bank account credit 500,000. XYZ business debit 500. Clear to you? So then this liability account will close, no more liability. So that is how it goes. Understand? You write it and raise your hands. If you can't see the thing, let me know. Once you finish, raise, unmute and tell me, right?
Yes, sir.
And raise your hands as well. Right. Okay. Done, right? Right. I'm gonna. This is about expense on credit. Just remember, we are issuing the check, we are crediting the bank. So there is an work example you can see. We don't need to do this. Let's see just here question. Uh, okay. A business transaction on July 2017 are shown below. Road goods on credit, 1,350 from Basha and Company. Road goods on credit, 3,400 from Basha and Sons. Road stationery, 84 for business use on credit from PG Supplies. Likewise. Okay, let's see the first one. Road goods on credit. So when we are purchasing the goods on credit, purchase account debit one, right? Basha Company credit, 1,350. Next one. Road goods on credit. Sorry, this is Baha and Sons, right? Another one, right? So when we these are two companies. So when we purchase on credit, our liability increase, right? So first one, purchase account debit, Basha and Company account credit. Second one, purchase account debit, Baha and Sons account credit. Second, third one. Road stationery. This is not the goods. This stationery for the business usage, and stationery also not an asset. Stationery we concern an expense. Why? It is for the uh, it is for the usage purpose, but it is now stationary means when something need to concern as an uncurrent assets or current assets, we should be able to use it more than 12 months or nearly 12 months, right? So what are the characteristics of assets? Huge economic benefits will inflow, controlled by the business, right? Arose as a result of past transactions. From stationary there is no any future economic benefits. Likewise, so stationary is an expense account, stationary account. So stationary account debit, PG supply account credit as stationary, right? Next one, sale goods on credit. So name, debtor, those, so we concern name as debtor account. So name account debit, sales or the revenue account credit. Revenue account means the sales account credit, since it is a credit basis, right? So then next one, return goods to Basha and Company. Now when we return the goods, Basha and Company account debit, we can't credit to the purchase account. Instead of, we credit into the return outwards account, purchase return account, right? Purchase return account credit. So from that term, because purchase return account is an expense decrease. Road goods on credit, when we purchase goods on credit, purchase account debit, and creditor Jogia account credit. So this is the Jogia's account is a creditor account. It is a liability. Just write it. First one, purchase account is an expense account. To mention, Basha and Company is a liability account. This is a creditor account. Every account belongs to some element. So Basha and Sons also liability account, right? Station, PG Supply is an liability account. Sales account or the revenue account is an income account. Naim account is an asset account. They purchase our goods on credit base. Asset account. Purchase return is an income decreases account. I told you, when we purchase goods, income increase. When we return it, income decreases, right? So then Jogia account also a liability account, because purchase on credit, right? Van service by Nada Gaj for 210 on credit. So when we repair the van, van is a service, right? So we obtain a service. So motor expense account debit, it is an expense account. Nada Gaj account credit, because we have done it on credit basis, so it is a liability. Till we pay back, our liability increase in liability, right? Then sold goods for cash. When we sold the goods for cash, cash account debit, sales account credit, cash account debit, sales or the revenue account credit. So cash account is an asset account. Next one, Naim returned the goods to us. Let's see who is Naim. Naim, we sold the goods on credit basis to Naim. When we sell the goods, revenue account credit or the sales account credit. So Naim account debit. In the Naim return goods, Naim account credit, sales return account debit 76. Naim account, so Naim account credit, sales return account debit, right? It is an income decreases account. When we sell the goods, income increase. When it return, income decrease. So the purchase return is an expense decreases account, right? When we purchase goods, our expense increase. When we return those, when we purchase goods, our expense increase. When we return it to the supplier, our expense decrease, right? So that's why it's credit. Then next one, paid PG supply, cash account credit. You can see cash account credit. PG supply liability account debit. Pay PG supply account debit. Easy clear you send me a thumb, right? This is how it goes. Understand? Can you hear me? All good? I'm audible. Just right. Can you hear me? Yes, yeah. Right. Hope you can hear me. So just remember. So when we sell the goods on credit basis, other person is a debtor. So we concern it is an asset account. That's why we identify from that name. So when we purchase goods on cash basis, there is no any name for the other business. Purchase account debit, cash account credit. Why we give the cash and there is no any obligation. But when we purchase goods on credit basis, purchase account debit, we identify other account as a liability account till we pay back. So we identify from that, right? Right. Now, before moving to the other part, right. So let's go to the next topic. The next part is about uh, revenue and purchases. Revenue and purchase are special meeting of accounting language. I told you. Revenue means the sales. Revenue means the sale of those goods in which the business normally deals with, that were brought within the main intention of resale. The description revenue must never be given to the disposal and the other items, right? It's disposal means removing a non-current asset. So this is just for the stock sales, right? Purchases means the purchase of those goods that have business, that the business buy with the main intention of selling. Sometimes the goods may be altered, added, or to use in the manufacturing something else, but it is the element of resale that is important. For example, a business that trades in computers will consider computer to be raw materials. If the business buys a motor van for use by the business, this cannot be called a purchase in accounting term, because the van is not intended to resell. I told you in the purchase account we include only the things which we purchase for the resale purpose. We purchase something for the usage purpose. For an example, van, we can't record under purchase account. Only it's record related to the stocks. Understand? Send me a thumbs up if it is clear to you. Right. Next one. Comparison of cash and credit transactions from purchase and revenue. You may now see the difference between the record of the cash and credit transaction. The complete set of entries for purchase that are paid for immediately by cash is follows: purchase account debit, cash account credit. If it is a cash purchase, purchase account debit, cash account credit, because there is no any future obligation, right? Right. Next one. The complete set of entries for the purchase goods on credit can be broken into two stages. First, the purchase of goods. Second, the payment for them. The entries for the first part are purchase account debit, relevant supplier account credit. So we identify relevant supplier is the creditor because it is a liability account. They gave the goods on credit basis to us. Till we pay back, we need to identify that person as a liability. The entries for the second part are, when it comes to the payment, liability account debit, which is supply account debit, cash account credit. With the cash purchase, there is no need to keep a copy of the supplier's account. This is because the cash passes from the buyer to the supplier immediately. So there's no need to keep a record of indebtedness, money owing to a supplier. In the credit purchase, the record should show to whom money is owed until the payment is made. The table below shows a comparison of cash revenue and credit revenue. You can see cash revenue, cash account debit, and revenue or the sales account credit, because at the point of selling, there is no any obligation. We don't need to, that person doesn't need to pay later. That person paying at the same of the time transaction happening, which means immediately. So we identify the other account. We don't need to identify the other business name. So just only the cash account debit, revenue account credit. Credit revenue. So first of all, we need to identify the credit sale. Sales account credit or the revenue account credit. Customers account debit, they are our debtors. When they are paying back, customer account credit, cash account debit. Now these are temporary accounts. For an example, if I take the sales, credit sales, sales account credit. Let's take ABC debtor, customer account debit. When they pay back, ABC account credit, cash account debit, right? This is just a temporary account. When they, till we pay back, we identify them. Once they pay back, the same amount credit. Now think the debit side is 1000, credit side of also 1000. When the same amount occurred, we can cut it off, right? So simultaneously, now since this is a temporary account, once they pay back, this is going to close. So like sales account credit, cash account debit also happening. Easy, creative, send me thumbs up, right? This is just a temporary account. Are you there, Leah? Right? Right. Hope you are all good. Stay strong. Okay. Balancing the ledger account. I also told how to balance. First, we get the higher value side and write it in the lower value side as well. Then we get the low value side total and deduct it from the higher value side. Then the BCD and B. Balancing of account is a procedure carried out by most business on the monthly basis, so they can keep on a check on various accounting issues. These issues includes how much money they have in their cash account, the balance of the bank account, how much money they owe to the other party trade payables, how much money they other people owe to the business, other which means trade receivables or the debtors, how much money the business owed to the sub people means the liabilities for the creditors or the trade payables, the value of the business assets, how much the business is having, the amount incurred on various expenses, how much their inventory has cost, what the revenue figures are to date, the equity invested in the business by the owner or any drawings taken. Likewise, we can, once we balance it, we can get to know. I told you, first we are seeing the higher value side. You can see in here higher values. Now the balance credit side is, now credit side is 0. Now you know there's no any transaction, just only the debit side. There are two, 405, 650. We take higher value side total and write in the lower value side also. Since lower value side is 0, 1050 minus 0 means 1050. So BCD and BBF, right? Likewise, I told you BCD means brought forward, balance carried down, or the balance brought forward, uh, right? BF means the brought forward. The opening ledger balance of for the period in question take from the balance BD from the previous year. CD means the carried down, the closing ledger balance for the period in question. This will be balance BD at the starting of the next period. Brought down, and the closing ledger that is used to start the next period. Now brought down, right? In here CD means carried down, balance carried down, right? BCD. So BD means balance brought down, carried down, brought down. BF means brought forward. Now it's like this. Now when we are balancing, think let's take wages. So 150, 150. You know the higher, first we are checking the higher value side. Higher value side is debit side 300, lower value side 0. So we are writing the same thing. So when we are balancing, we take balance carried down BCD, balance brought down BBD. Understand? So the same thing. Now think this is May month. Now when it comes to the June month, let's take not the wages. Let's take like let's take motor vehicle account. When we in the next month, right? Starting date. Now when it comes to June month, we take the last month closing balances, right? So we take balance brought forward 300 is equal to send, right? So next month opening date, we call it as brought forward, right? Opening date. In here BCD means closing date and next month. Now when we are closing account, we are just increasing balance brought down. Last month closing balance is the next month opening balance. That is the thing, right? The same thing we have discussed how to balance the ledger account. I think I don't need to repeat it again and again, right? It's easy. Three column account. Three column account. Some accounts are shown three columns: a debit column, credit column, and balance. For an example, mostly in the bank statement also you can see credit debit balance. This method of presenting accounts is used in computerized accounting package. Mostly in the computerized accounting package, there is no any. Now when it, this is the ledger account format. Three column format means, you know, we just have at the end of the each and every transaction, debit, credit, and the balance, we are balancing. But when it comes this kind of account, we balance at the end of the period. But in here, now think balance is 3000 credit, 3000 credit. When we add another 300, now the balance increase up to 3300 credit. When we debit 1000, so the balance 2300 credit. Likewise, at the end of the each transaction, it balancing in this 3 column format. But in here, you can see we balance at the end of the period. Clear to you? Send me a thumbs up, right? So that is how it goes, right? 3 column format, you can see credit balance. In here, credit means adding, debit means work example. The following account had been extracted from the books of John Robert. Roberts run a successful retail business. All the accounts have been balanced off by the bookkeeper and the trial balance have been prepared. Note that that details of trial balance will be covered in chapter 8. Okay, you can see these are the bank account, cash. So have the figure 6.7, 6.8. What are the transactions? Right. This is the way they have recorded. And we did the trial balance as well. Can you remember, guys? I did, right? I did this one with you guys. Can you remember? Send me a thumbs up. You already prepared a trial balance as well, right? Can you hear me? Send me a thumbs up. So we already did, right? Errors. Errors not revealed by the double entry system. You should be aware that trial balance will still appear to a balance even certain errors have occurred. Errors of transposition when the numbers are entered backwards in the both accounts. Like for an example, think now what is the way we prepare. I'll tell you. I'll take few transactions and I'll explain it to you. Right? Just wait. I'll take few transactions. Right. Okay. Just wait. Let's take an example as well. Then you can. This is better. Take this. Give section here. Better we can just wait. I'll show it. Right. Can you see this one? I'm audible to you. Can you hear me?
Yes, sir.
Okay. Just write this one. Opening balances, cash balance, debtor balance, motor vehicle balance, bank loan balance, creditor balance. Right? First write the balances and raise and I'll show you the transaction. First write the balances. Let's do this work example. Then you can have Once you finish, raise your hand. Just write the opening balances. To finish, raise your hands. Hope you understand.
Yes, sir.
All good? Done? Opening balances.
Yes, sir.
Yeah, okay. Right, July month transaction. No, just let's change this. Can you write this as a write like this? Data uh, XYZ. Change it as data XYZ balance. Right? Cash received from data XYZ. Right? Cash pay and the creditor balance, change it as creditor ABC balance. ABC. Right? Then cash received from data XYZ, cash paid to creditor ABC. credit purchase from P, cash purchase owner, right? Okay, likewise. So just remember data XYZ balance, creditor ABC balance. Is it clear to you? Right? Now, July month transaction. Hope it's clear to you. Right? These are the July month transactions. Can write cash received from debtor XYZ, cash paid to creditor ABC, cash sales, credit purchase from P, just only P, the business name is P. Write the transactions and raise your hands. Is it clear to you? When you're writing the opening balance, just take data under balances, data XYZ balance, creditor ABC balance, right? Then write the July month transaction. Is it clear to you, Liashi? Just right. All good? Can you hear me?
Yeah,
If there's any concern, you can ask. Once you write, raise your hands. I'm waiting for raise hands. Then we can start it. Oh, still ready? What is the situation? Can you hear me?
So I'm writing the seventh one.
Just the 7 and 8 both are same. It's only the 7. Also, paid bank loan installment rupees 25,000, including 5,000 bank loan interest. Once you done, let me. Once you done, raise your hand. Right. Now let's start from here. You can see I have given you the opening balances. So we need to have the ledger accounts. The place where we maintain all the ledger accounts is the term we call as ledger for the general ledger. Just write the heading Ola and LKR. So this is July month transaction. July, right? So first of all, these are balances. You need to have the cash account. Then you need to have not only that, for every account, right? Keep some space to balance as well, right? Then after that keeps XYZ balance. So it is a data. So you can see, so XYZ account, XYZ account. Cash account is an asset account. It's obvious. XYZ also asset because they are our data, right? Motor vehicle. So you need to have another account as motor vehicle. Then you need to have a bank loan account. It is a liability account. Liability account. Then ABC, creditor ABC balance. So to have ABC business. So this is a creditor account. So creditor account means a liability account. Creditor account means this is a liability account. Let's write the opening balances. In here, you can see it clearly mentioned, right? Just remember, when you are writing the opening balances, you can see you can see right? Opening ledger balances, right? So you can see BF, right? So you can write balance brought forward, opening balances. So let's draw the opening balances. Cash balance 300,000. So balance brought forward 300,000. Then XYZ is an asset account, so balance comes the debit side. Asset and expenses always debit, so it's 100. Can be changed as well, but debtors balance are motor vehicle balance. So motor vehicle is also an asset, so balance brought forward debit side. You can see 500,000. Then you can see bank loan balance. Bank loan is a liability, so balance brought forward comes under credit side, 400,000. ABC business is a liability account, so balance forward comes under credit side, so 150. And what I want to tell you, just remember every time total of the debit should be equal to total of credits. Debit total is 300, 400, 900. The debit total is 900. In here, credit is 550. These are assets, these are liabilities. The remaining part you need to write it under capital account. Capital account belongs to the equity, right? So we identify as remain. They are not giving the equity. If they are not giving the equity, fine. 350. So 350. Now the credit total also, uh, yeah, it's also 900,000. 350, 150, 400, which means 900, 300, 100, 500, thousands are 300,000, 500,000, and 100,000. Those are 900. This is also 900. Credit and debit total is tally. Hope it's clear to you, right? Now let's balance the let's record the transactions they have given. First one, cash received from debtor XYZ 50,000. So cash account debit as a XYZ account. The balance is sorry, the transaction is 50,000. So number one, when they are paying, they are as a decrease as cash 50,000. Let's write the number two. Paid cash to ABC 50,000. When we pay cash, cash account credit 50,000. ABC account debit, liability decrease as cash 1,000. Cash sales. We need to have another account called sales account. I told you, right? Sales account is an income type of account. When we sell goods, we record under income account, right? So, sales account credit. Number three, as cash. The balance is this is the cash sales. What is the amount I gave you? Can you tell me the third one amount you wrote in here? Can you hear me? I'm audible. Yes, I'm audible to you. Can you hear me? It's 90,000, right? 90,000. He wrote it as credit sales 90,000. So when the credit sales is 90,000, you know, sales account credit, sorry, cash in here, the first one, cash sales 90,000. So sales account credit. Number three, cash account debit. Next one, number four, Credit purchase. So you need to have account called P's account. P is a liability account because we purchase goods on credit basis from this person. Liability, right? So when we purchase goods, liability increase. So number 4 as purchase 100,000. Purchase account debit. You need to have another account called purchase account. When we purchase account, purchase is an expense account. Expense increase. Number 4 as fees account 100. Cash purchase, cash account credit, purchase account debit 80,000. Cash. Number 6 owner's cash drawings 5,000. When owner withdrew cash, cash account credit, we debit the drawings account 5,000. Drawings is an equity decreases account. When owner withdrew things, owner's ownership decrease. There's another account called drawings account. It is an equity decreases account. Drawings account debit as cash. Right, right. Now next one. Paid bank loan installment 25,000, including 5,000 bank loan interest. This part is really important. We paid bank loan installment. This includes bank loan interest. Bank loan interest is an expense. Out of the 25, 5,000 is bank loan. Totally we paid cash 25,000. But out of 25,000, only 5,000 20,000 relevant to the bank loan. So bank loan debit. Bank loan interest debit 5,000. Just remember two debit entries 20,000 and 5,000. One credit entry. I'll write bank loan and bank loan interest. Right? Right. Now here after balancing the things, we can prepare a trial balance as well. Right? Let's balance and let's prepare a trial balance. I told you first find the higher value side in here 440, 440. The lower value side total you can take. When it comes to the lower value side, you can see it's 50,000 plus 80,000 plus 5,000 plus 25. It's 160. So 440 minus 160 is 280,000. Balance carried down. Balance brought forward or brought down 200. Let's prepare trial balance as well. told you the format of the trial balance. Trial balance, account, debit or credit, cash, 80,000, right? When we see the cash XYZ account, you know the higher value side is debit side, low value side 50, 100,000 minus 50,000 means 50,000. So you can see XYZ account, since it is an asset account, it comes to the debit side. When we balance the motor vehicle account, you can see the higher value side is debit side, lower value side is 0. So balance carried down 500,000. Balance brought down 500. This is, motor vehicle, 500. You can see when it comes to bank loan account, 400,000, higher value side. So low value side 20 means 380. Balance carried down. Balance brought down, right? Bank loan account, and then when we see the ABC business account, 150 credit side, he also 150. 150 minus 50,000 means 100,000. Balance carried down. Balance brought down. It's 100. Can write, since it is an liability account, so ABC business account, no credit. Capital account is, you can see, 350, 350. Balance carried down, 350. Balance brought down, can write as capital account, 300. Sales is an income account, 90,000, 90,000, 90,000, because since this side is 0, balance carried down, balance brought down. Sales, you can write credit side 90. P account, it is a liability account because we purchase goods on credit basis from them. So 100,000, balance carried down 100,000, then balance brought down. Fees account, credit side 100. Like purchase account, 180,000, 180,000, balance carried down 180, balance brought down. Can write as purchase, debit side 180. When we check the drawings account, debit side 5,000, credit side also 5,000, minus 0. Credit side balance is 0, so 5,000 minus 0, 5,000. Balance down, balance go down 5,000. Bank loan is a liability account, 5,000, 5,000. Balance carried down 5,000. Balance go down 5,000. Right? Bank loan. So this is bank loan interest side. Something wrong. We missed the drawings account. Drawings accounts also 5,000. Let's balance and sell check with the totals are telling. You can see 80,000 plus 50,000 plus 500 plus 180 plus 5 plus 5, which means 820,000. If the total number of debit entries are equal to the total number of credit entries and the ledger accounts have been balanced properly, the total of the debit should be equal to the total of credit. 380 plus 100, 350. Oh, see, 80,000 plus 50,000 plus 500, 180 plus 5 plus 5. Okay, there's a row. In here, credit side 380 plus 100 plus 350 plus 90 plus 100, 800. There's a 200,000 difference in here. Let's see where is it. Let's see. 3, 4, 9 in here, 400,000 plus 100. Can you just find the reason? 3,000 here. Number one, XYZ account credit cash. Number two, one. Number three, one. This one, four. C. Purchase account debit, account credit. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 1, 2, 4, 5, 6, 7, 7. Bank loan account 5,000. Bank loan interest. Drawings accounts also 5,000. Purchase account 180. Fees account 100. Sales account 90. Capital account 350. Uh, ABC business 100. Bank loan account 380. Motor vehicle 500. XYZ 50. Cash. It's 280. Sorry. It should be not 80,000. The balance is 280. It's my mistake. Now it's fine. Now 200 different. Now it should be balanced. Now it's balancing. See, if we made a single mirror, everything will be wrong. 280 plus 50 plus 500 plus 108 plus 10, which means 1020. Right? In here, 380 plus 100 plus 350 plus 90 plus 100. Yeah, the same 1020. Is it clear to you? Send me a thumbs up. Right? I'm audible to you. Can you hear me?
Yes, sir.
Okay. Can you write it and raise your hand? Take your time now. You are a little tired, but once you finish, raise your hands. I'll give you enough time. Once you done, raise your hands. Writing still. What is the place you are writing? Can you hear me?
So, like I'm writing on the right side.
Means like right side means you are writing
Right
the,
side of the board.
sorry,
So, the right side of the board.
right side. So which means you are writing the trial balance.
Yeah, but like the purchase account and drawing. So, like I'm writing that side.
Okay, once you finish, let me know.
Okay. Done, sir.
Okay, so then you need to have a clear idea about this part, right? Now you can see in here that is the term called trial balance we discuss. So and the errors and the other part I'll discuss on Saturday. Clear to you, right? Then we can finish it. Then and go to the previous part because I have missed the previous part. So we need to go and we need under introduction to book. I did the first part and I just missed the primary book part, right? So which sorry, different. I finished the ledger accounting and double entry principle, but I part which the books of original entry. I want to do it after that. Okay, let's do this Saturday 9 a.m. Thank you for the participation. Bye. Night. Good night.
Yes, sir. Good night, sir.
Okay, bye.